Right, hi evening everyone. Okay, welcome to day 17 of Project Options Cashflow. Now, if you can hear me, drop a note and a comment to say hi. All right, hi everyone. Hi Uncle Fu. Hi Josephine. Hi Anthony. Hi Irene. Okay, great to have all of you here. Okay, so let's take a couple of minutes over here while we wait for more to turn in and join us in this live session that we are running over here. All right, give me a couple of minutes. Okay, sorry. Hi, Gary. Hi, Uncle Tan. All right, hi CT. Hi May. Okay, now, so I hope all of you found yesterday's session pretty much, good information and very, very useful as well, because today we're going to leverage on what we talked about and what we discussed yesterday. Okay, so today can be seen as a strategy on its own, okay, or it can also be seen as part two, right, to yesterday's strategy. Okay, all right, now, so today's strategy can be applied on its own. Okay, it can also be used as part of yesterday's strategy. So I'll be discussing that a little bit further in today's session. Okay, all right. Now, I hope if you're joining us as well, you have brought a stock along with you for tonight's discussion. Okay, because we will be using some of these stocks and looking out for some trades on them and possibility of trades, as well as the benefits and the returns that you're capable of making with today's strategy. Okay, on the stocks that you're looking at. Okay, now that would add a lot of practicality to the session itself, which is something like that I like to do for my sessions, both with students as well as informations and sessions that I'm running online over here right now. Okay, right now. So once again, welcome to day 17 of the entire month of June, where we are running Project Options Cashflow. Our aim and our goal is to educate retail investors to know more about options, okay, and to also reach out to them during this period, as many will be trying to find better ways to invest their money and also to grow what they have to better prepare for the next right now we could say probably prepare ourselves for the next crisis that may happen somewhere down the road. Okay, all right now. So COVID has already hit us, it's already happened, so I can't really do much about it except to help you make it better, right? But definitely we want to be prepared for the next one, when it comes around for any one of us, okay? All right, now, so once again, if you have not clicked on the share button, the practice is the same. We have a summary sheet prepared for tonight's session. All right, so if you want a copy of the sheet and a downloadable link to the summary sheet, okay, please click on the share button so we'll be able to leverage on your attendance as well to reach out to your friends who may actually have an interest in investing as a whole. Okay, now it'll be good and it'll actually be helpful, all right, if you leave or type something out at the top of the video before you actually share it out. So your friends may actually be able to tell what the video is about and what information will they be able to get out of it. Okay, now today's strategy can also be deemed or commonly known as the rental income strategy, all right, when it comes to the stock market. Okay, now so people buy properties to create rental income, right? But few people actually know that you could do this in the stock market as well, okay, where you could actually buy these stocks, all right, and also do something similar, which is rent out these stocks over here, okay, for the creation of some income as well. Okay, now, so the concept doesn't have to be too complex. It doesn't have to be too difficult as well, right? To keep things simple, okay, why do people buy property? Right, one of the reasons are simply because they're looking for great properties, but great properties usually require some time to appreciate in value. Okay, so likewise in the stock market, to make money, you should be also investing in great stocks, but at times greater stocks are usually cash cow companies, and usually they also take some time to appreciate. Okay, now so by renting it out to some people, we're actually able to generate income, right, while holding on to these stocks and waiting for their appreciation. Okay, now so today we'll be discussing this further throughout the session. Okay, now so just one more time before I get started with tonight's session. if you have not joined us in our Telegram channel, okay, we've announced yesterday that soon I'll be starting the live trading session once a week. So it's going to be live cash flow strategy with Terence for one trade a week, where we look at a stock and we'll implement strategy we discussed yesterday, which is selling naked puts, right, as a live trading event. Okay, so we can't set an actual date to it each and every week. So if you're part of our Telegram group, okay, you will be best notified as we will make posts inside the Telegram group to inform members who are in our group channel. Okay, now, so let me just quickly get through the stock lingo that we have highlighted for today, which is short selling. Okay, now, so short selling should be something commonly known to many of you who are with us. Okay, it's the idea of selling something first, right? Which means you're selling something that actually you do not own, okay, but in return, you have to make a promise to buy it back later, right? Because if you're selling something that you do not own, okay, if you buy it back later, you can actually just replace it to someone. Okay, right now the concept in the stock market behaves like this. Of course, you're not allowed to sell something that you do not own, right? But the stock market has the right to allow you to borrow a stock, so you could be allowed to do such an action. Okay, but of course, when you buy it back, you are required to return it, right, to the person you borrowed it from. Okay, so this is how the stock market actually facilitates such a transaction, right, to happen over here. Okay, now, and I'll actually show you when we go to the stock itself, all right, later on. If I don't remember, please remind me. Okay, how do you know if the stock you're looking at is actually easy to borrow or it's actually difficult to borrow? Okay, now you should not be borrowing or you should not be short selling, okay, a stock over here where it's actually really, really difficult to borrow in the stock market. Okay, why do people say this? Because I think it was quite a couple of years ago, right? If you can remember, all right, where in the European stock market, we actually saw Volkswagen stocks hit $1,000 in a day, right? That's because of the short sellers over here, all right? The short sellers were caught, all right? They were trying to cover and there was not enough stocks to go around. Okay, so it caused this whole issue over here, right? And created the problems. Okay, all right. Now, so let's get started. All right, click on the share buttons and you'll be entitled to the summary sheet, okay, which we'll be posting in your shared comments over here. Okay. Okay, all right, now, so welcome to I'm Possible Investors, Project Options Cashflow for the entire month of June. Okay, so we're going to put ourselves to a challenge for the entire month of June to highlight and bring to your attention how you could use options, or specifically stock options, as an investment tool to create cash flows for your portfolio. Now, there are many ways and forms to invest. People invest for capital gains, people invest for short-term gains, people invest for long-term appreciation, people also trade for day trading profits. All right, we want to create cash flow. So our focus is really on cash flow, because cash flow is something you could make it happen over and over again, and it allows you to build on it and achieve and plan your financial security. Okay, now, disclaimer, anything that I'm going to discuss in today's session is purely to educate you and let you know better about stocks and options trading. Okay, so if I do bring any stocks into example and discuss any trades during the session, right, if you are within our community, please make your own risk assessment before doing so. And if you're a complete newbie, please seek some professional financial advice before you go ahead and do so as well. Okay. So today we're going into day 2 of the Portfolio Builder series. Okay, so today we're going to cover the covered call. Okay, the covered call. So what's the purpose behind this strategy? Okay, how do we use the strategy? Okay, and I'll skip the rest because we're going to do it practically like yesterday, which means we're going to go straight into the stocks and discuss how we can use stocks and what kind of returns we can create. Okay, now, so let's do a quick revision over here. Now, so the revision over here has to be about selling call options. Okay, now, why do we say it has to be about selling call options? Right, because when we talk about covered calls, it is actually owning the stock. Okay, so you're actually owning the stock, right? And you add on a sell call position. Okay, so you actually own the stock and you add on a further sell call position over here. Okay, so that's actually what a covered call is over here. Now, so if you remember selling a call option, too much copy and pasting over here. Give me a minute. Let me edit the slides. And also, I just remembered as well to put it up. Yeah. All right. I haven't launched my slides. Give me a minute. Okay, great. Now it's up. Okay, all right, now, so just going back quickly over here. So I mentioned about portfolio building series, covered call, the purpose of the strategy, and how to use the strategy. Okay, now, so today we have to cover a quick revision on selling call options. Okay, now why? Because covered calls are essentially a strategy which comprises of owning a stock, okay, owning a stock plus, all right, a sell call position. Okay, so owning a stock plus a sell call position. All right, now, so let me bring out my pen. Okay, all right, now, so own a stock, okay, plus sell, all right, a call option. Okay, now, so when you're a seller of call option, you take on the potential obligation, okay, to sell a stock. Okay, now, this is the reason why to do it right, you must actually own a stock first. Because if you own a stock first, right, you would have already paid for the stock, okay, which means you clearly know how much you paid for it. Okay, now, so by choosing a sell call option to sell, all right, you can actually determine if you're going to end up making a profit on the stock, okay, and create extra income from what you collect when you sell, okay, or if you are, trying to recover some losses from owning the stock, okay, you could also sell call options to do so, all right, because of the premiums that you collect. So it all depends on what's the strike price that you choose for your call option. Okay. Now, so with call options, there's always an agreed price to deliver the stock. So in this case, it's an agreed price to sell the stock at. Okay, now next is all down to a deadline. All right, every option has an expiry to it. Okay, so what's the expiry date that you're looking at and choosing, right, when you're structuring the trade over here? Now, so what do you get? Why do people want to do this? Okay, people love doing this because, all right, they get to collect cash upfront. They have a sideways or bearish buyer's view. Okay, all right, now, and they have break evens before losses. Okay, all right, now, so I mentioned earlier, a covered call is really owning a stock. Okay, so let's talk about this first. Right, so first you have to own a stock. So if you don't have a stock today, that means you probably have to go out. So let's take Wells Fargo, right? You'll go out and pay today's price to buy those stocks. Okay, so today's ask price is $24.45. So if you buy it, you probably have to pay that price. So you own it for $24.45. Okay, and then you could go out, okay, and start planning. Do you want to rent out the stock for 42 days? Do you want to rent it out for 57 days? Or do you want to rent it out for 92 days? Okay, now, so if you're willing to rent it out 3 months out, okay, that means a 3 months out option, a call option, okay, a call option as you can see on the screen, okay, open it up, okay, and let's say you're willing to sell a 25 strike call option, okay, the stock market is actually willing to pay you somewhere around the middle of the bid and ask price. Okay, so in my example, I put down a price 218. Okay, so the stock market would allow you to place an order to sell the call option for 25 call, right, at a price or premium, option premium of $2.18. So if you go ahead and go to the platform right now and submit the order to sell, right, this goes into your account, okay, while owning the stock. Okay, so essentially for the next 90 days, right, you get to keep your stock, right, and you also generate an income, right, of $2.18, which somebody just paid you for it. Now, what's in exchange for this money, right? Because when somebody else pays you some money, right, something is always involved, right? There's some obligation, there's some responsibilities. Now, so this is how it looks like. You have a stock today that's trading at $24.44. When you sell a call option, right, you should actually see the call option functioning as somewhat we call a roof over here. Right, which means, okay, wherever the call option is being sold, okay, that's where you have to end up selling the stock, all right? So if you actually own the stock at this price, okay, that means that there becomes a ceiling in terms of how much profits you could make the stock. Okay, now, so if you bought the stock at $24.45, right, you have made a promise to sell it off to someone at 25. Okay, because if you remember, the obligation was to sell the stock. Okay, now, and it was to sell it at this strike price which we agreed on. So if you buy a stock at 24.45, okay, and you promise someone that you sell it off to the person when it hits 25, okay, that simply means, all right, that there is still an upside potential, right? The upside potential is 55 cents. Okay, all right, now 55 cents in capital gains, okay, all right, plus $2.18 in income, all right, which you collected when you sold the call option. Okay, all right, now, so the $2.18 actually functions, okay, to help you bring down the break-even cost on owning the share as well, right? Because you collected some money, which means the cost basis of your stock actually went down, which is how some property investors, focus on as well. Every month's rental actually helps to pay off the property. Okay, now, so the red line or the call option where you have sold it actually determines the max profit, okay, on the stock that you own. Okay, all right, now, so you could also do it another way, all right, which means, okay, if you don't foresee a lot of upside on the stock, so what you're focused on is you're focused on cash flow, right? Which means you don't think the stock is going up by too much, right? You want to be able to collect a much fatter premium upfront, right, by renting out the stock. But if you're holding on to a stock where you actually see capital appreciation potential, right? If you actually see capital appreciation potential, right, what you may want to do, okay, what you may want to do over here, right, is to actually choose a slightly different call option. Okay, what you may want to choose over here is to pick a higher strike. Okay, a higher strike call like $30, okay, for the same expiry, but of course, you're going to get paid much lesser for that over here. All right, now, so you're only going to pocket 70 cents, okay, but how does it make the situation different? Okay, let's take a look. Now, what it makes it different is basically, as you realize, I said the red line, which you mentioned earlier, all right, is now drawn much, much higher, all right, because obviously, all right, how do we say this? Give me a minute, okay? All right, now, so I just hope the lighting is much better now. Okay, all right, now. Okay, now, so if we sell the 30 call, all right, so compared to $25 where we drew it earlier, right? So compared to the 25 call earlier, all right, the position line has to be much higher, right? Because it's a much higher stock price. Now, that also means that our profit, all right, our profit on the stock is actually now at $30, right? It's actually now at $30. So we actually still keep an upside potential right now of $5.55. Okay, $5.55. Okay, all right. And if it actually goes above, right, we get to make $5.55 in capital gains plus, all right, 70 cents premiums that we collected from selling this call option. Right. So this way of selling covered calls is basically a way where you could say it like, you have the apple and you get to eat it too. All right. Okay. Because if the stock really shoots up, right, you would feel an agony over here if you sold the 25 call, right? Because you have lost out on the potential, capital gains profits that you could have made over here. Yeah. As in this example with the 30 call that we just showcased to you. Okay, now the break-even price is much higher because we collected less in terms of the premiums from selling the options. Okay, the max profit now is much higher for the stock. Okay, all right. Now, is there any fancier way to do this? All right, now, so I just showcased two ways. Okay, I've showcased two ways and two different ideas that you could use, right? A covered call strategy if you actually own a stock. Okay, all right. Now, do you think these are the only two ways? Okay, or do you actually think there are more ways in which you could do this over here? Right? I like those of you who are joining me in tonight's session over here to participate a little bit. All right. So do you think there's only two ways which I just mentioned, or do you think there's some more ways in which we could sell a call option over here? All right. Now leave your comments over here and let me know what you think the answer is. All right. Okay. Now, those of you who are joining us and sitting in the session, listening in right now, Okay, what do you think are the answers? Right? Is there only two ways which I've just highlighted, or do you think there's actually more ways in which you could sell call options if you actually own a stock? No, Zen, right? No, Zen. I'm just saying, if you actually own a stock, right? Is there any extra ways? All right, Christine, you said 3, right? So if you say 3, right, then what would be the last way, which I've not covered yet? Okay, what do you think is the last way that I've not covered yet? If you think there's 3, okay, all right. Now, Zen, no, we are not selling naked calls over here today. This is not the strategy. Okay, anyone else? Okay, while I wait for the answers over here, I'm just going to take this moment, all right, to also just remind those who have joined us late today. Okay, do click on the share buttons for the live video, right, and leave a comment before you share it out. Okay, to let your friend knows what this video is about, right, before they join in and watch on it. Okay, and how they can benefit from it. Okay, now in return, we'll be posting a downloadable link for the summary of today's strategy. Okay, and all the different ways that you can sell the call option. All right, great. Okay. Christine, all right, sell the stock as it is. That was actually the last one that we covered, all right, because when the stock was trading at 24.45, okay, selling the 25 call, right, selling the 25 call is as good as selling, where the stock is, right, because this is probably the nearest one that you can get over here. All right, now, so actually, let me bring it up. Okay, all right, great. Okay, so Yup is right, Zen is right, Jenny is right. Okay, all right, so Yup, Jenny, and Zen is all right. Okay, now you can do it one other way, which is to sell the call option when it is in the money. Okay, now, so before I do this and show this to all of you, I wanted to make you think about it first. Okay, now, why do I want this? Okay, simply because why would you actually do such a thing? Okay, now, because, for example, if you do this instead, right, the same August expiry, right, you own the stock at 24.45, which you've just bought it, okay, but this time, you're actually going around and instead choosing to sell a $20 call option. Okay, that means you're choosing to sell a $20 call option. Okay, but for that, you could pocket anywhere from $5.36, right, up to $5.40, okay, from this sale, all right, which is down the middle over here. Okay, right now that's anywhere the premiums that you can pocket, right? $5.40. Now, so what happens over here is then this, okay? You would have a call option now, a line that is now actually sitting below the stock, right? It's actually sitting below the stock, which means, okay, even if the stock stays where it is right now, okay, your customer, all right, is going to come around, all right, and get those stocks from you. Okay, because their purchase price is actually $20, right? So you're obligated to sell the stock at $20, which means, all right, it's going to happen, all right? It's going to happen because the stock is much higher right now. So if you do that, right, and you realize, okay, you are actually creating a scenario, okay, immediately, okay, you're creating a scenario immediately, right, where you have designed a trade that will make you lose $4.45 on the stock. Okay, you just designed a trade that would make you initially, right on the start, lose $4.45 on the stock. Now, why would we do this? Okay, why would we do something like that? It's simple, because if you realize when you sell, right, when you sell the call option, the stock market was actually willing to pay you $5.40, okay, for this call option. Okay, now, so people do this, all right, simply because they actually do have a bearish outlook on the stock right now. Okay, so what they're doing right now is they're ramping up, all right, the protection on the downside. So let's say you buy Wells Fargo today, all right, and you're really doing it because you think it's going up, but you're also worried that there's a downside to it. Okay, now, so what you can do over here is you can pocket some of those losses up front, right, by selling such a call option. Okay, now you realize if you offset these two amounts over here, right, there's a leftover, right? There's a leftover over here of about 95 cents, if I didn't calculate it wrong. All right, and this 95 cents is actually a credit, which means, okay, it's still a profit at the end of the day, right? When your customer takes those shares away from you. Okay, all right, now, so you're still going to make a profit, not too much over here, but just 95 cents. Okay, but if the stock actually drops, okay, and it drops to somewhere around $21, okay, if you didn't do this, all right, you have lost, or you would have a paper loss of $3.45 on the stock, okay, but now, right, it would have been covered by the premiums that you collected upfront. Yeah, okay, all right, now, so if you actually own the stock for much lower, actually, that means you bought it a long time ago, but by today, the stock has actually gone up much higher, okay, but now you're worried that in the next 1 or 2 months, you may actually see some downside, okay, but you don't want to let go of the stock as well, maybe because it pays good dividends or something like that. Now, or you just really want to keep it in your portfolio and sit it around for a long time to come. Okay, now, so for that reason, you could offer yourself some downside protection, right, by selling what we call an in-the-money call. Right, so an in-the-money call usually packs, right? It usually packs, like we said and discussed before, right, the claim value on the option, right, which is at the moment $4.44, okay, based on the market price, right, and it adds on a little bit of time value, right, and that's why you realize the market price was $5.40. Okay, right, now, I hope this clears it up, because when you do so, right, it actually makes the break-even price on the stock much lower right now. Okay, it brings the break-even price on the stock all the way down to 1909. That means in 3 months' time, even if Wells Fargo goes all the way down to 1950, let's say 1950, which is now below, right, your call option strike price. Okay, so your customer is not going to make the claim because it went below, so it's not going to make the claim. All right, now, but you get to keep the share, right, and still, all right, be able to boast a little bit of profit, right, at the end of the day. Yeah, okay. Now, so when you do it this way, what you really want over here is what we call the downside protection. Okay, the downside protection. Okay, now, before I jump on to the next category, right, is there anyone who has questions with regards to selling call options that are in the money when you own a stock? Okay. Anyone with questions before I move on to the next part and next slide? Okay, if you do, just leave it in the comment section over here, right? And I'll be able to pick it up and I'll follow through with it after. Now, so for such a trade, we actually started off the whole entire trade at the max profit level over here, right? Max profit level over here. Maureen, okay, so Maureen comes up with a question over here, right? And her question is, okay, what is generally a good time frame for covered call? Right, what's generally a good time frame for a covered call? It's actually entirely up to you, right? We'll discuss this a little later when we actually go to the platform and see some live trades. Okay, but you could sell options. You could sell a call option with any expiry date that's available, all right, on the stock that you're looking at. Okay, but what I usually would like to do is to analyze, okay, and see what's the best deal. Right? Okay, like when you go shopping, right, you always try to look for the best deal for the same item. Right now, so you can look first to determine the strike price that you want to sell, okay, and then you look across a couple of different expiry dates, and then you try to identify what's the best deal over here. All right, now, what do I mean when I say that? For example, if you spotted this particular strike, all right, and the premium for 1 week was actually 20 cents, okay, and then you realize that the premium for a month is actually going for $1 instead. That tells you, all right, which is a bargain, right, or which is a better bargain. Okay, now, obviously, all right, if you do your calculations right, okay, the monthly option actually looks like a better bargain, because even if you repeat the weekly one, which pays you 20 cents 4 times in a month, right, you actually end up with lesser than $1 over here. Right, so usually you pick up that deal over here. Okay, all right, now, so you weigh the balance over here and decide which one you like more. Okay. All right, I hope I answered the question and bring some clarification. So how do you use this strategy? All right, use this strategy, all right, really on stocks that you probably have already owned, all right, but you get frustrated because you're sitting down and going nowhere. right? So you could do it on boring stocks that you're owning, right? And you realize that your stock has started to channel, right? That means they started to channel within the price range over here, right? And you can pick a call option to sell at the top end of the price range, okay, where it's channeling from, okay? Because this will allow you to let the stock continue to channel, right? But at the same time, you are able to generate more profits while it's doing so, right? Because one of the biggest frustration that comes with stock ownership is to sit on the stock but not able to make any money out of the stock, okay? Right? So it could also be seen as an extra income from stock ownership, okay? You basically do this upfront. You exchange potential profits, which is down the road, right? Something that's not confirmed, right? For what we call an upfront income, right? Because once you sell the call option, you are getting paid by someone in the stock market. Okay, now this is also done when you're trying to protect yourself from some short-term downside risk over here. Yeah, right now. So you sell a call option, right? Pardon me for doing this. Right, you sell a call option basically when you're feeling too rich, right? And you're bored of waiting. Right? Now I basically say when you're feeling too rich because it's costly. It's costly to build a portfolio of owning stocks. So that's why I basically say if you feel rich, you should do this. Right? Otherwise, you should be better off served, selling put options like we discussed yesterday. Yeah, all right. Now, let's just quickly look at things that can happen over here, potential scenario and potential outcomes, right? One, if the stock goes up, okay? One, if the stock goes up, oh, my numbers are wrong, actually. Oh, yes, it is, right? It is for the first example, right, which is the 25 call. All right, so this example was based on the 25 call option. Okay, now, so if the stock goes up to 30, all right, you get to keep the premium, all right, which is 18 cents, all right, but you only make 55 cents, right? So this is an error. You make 55 cents on the stock. Okay, so it's slightly lower over here, right? Okay, but you're still making around 11% over here, all right, in 90 days. That's not too bad, all right? Okay, 11% in 90 days, which means, all right, you could do this, all right, 4 times in a year, right? 4 times in a year, right? And that's a pretty good return if you look at it this way. All right, now, next, if the stock stays where it is, right, you get to keep $2.80 from, all right, the 25 call. All right, just gonna write it down, $2.18. All right, now you get to keep that, all right, and that presents an 8.92% ROI, all right, even if the stock doesn't move, right? So if you do this 4 times a year, all right, you're still looking at 9, 18, 27, 36, right? 36% return over here, right? Which is really, really good. Yeah, all right. You can't complain when you're building a portfolio for the long run, all right, and gives you such a return. Right now, if the stock goes down to $20, right, you get, you're owning the stock right now, and you're looking at a paper loss of around $2. Okay, right now you're looking at a paper loss of around $2 because your cost price was $24.45, right, minus $2.18, which you got for selling the call option. Okay, now, but if you continue to own the stock, what you're looking at is really paper losses, right? And then you could continue and sell another series of call options while waiting for it to recover or waiting for it to go up again. All right, now, so it's definitely a much better way to owning stocks, especially when you're owning some of the biggest cap stocks in the stock market, right? Because if you don't expect the stocks to fly, definitely you don't want to do this on Facebook, you don't want to do this on Amazon, you don't want to do this on Tesla, right? But you probably do something like that if you're owning stocks like Coca-Cola, right? Owning stocks like maybe P&G, right? Your cash cow companies, right? Because if you don't expect the stock price to move too much too far, right, this becomes an excellent income generator. Okay, all right, now. So I hope I clarified that over here. Any questions so far, all right, before we go further? All right, if not, okay, I'm going to jump onto my brokerage platform and discuss some possible trade ideas over here. Okay, now, so if you don't have questions, bring on your stocks, okay, bring on some of your stocks over here, leave your stock ideas in the comment section, okay, and we'll take some of those and discuss when I go over to the brokerage platform. Okay, so the first 3 is going to get discussed over here. So let's see which are the first 3 stocks that turns up. Okay, while waiting for the rest of you to leave your comments, okay, what I'm going to do, all right, since Uncle Fu is with us today, all right, I'm going to go with Uncle Fu stock yesterday of EPD first. Okay, all right, now, so EPD. right? So there's two ways to play EPD, all right? Which means the first way over here is like we discussed yesterday, all right? We could go to the markets, all right? EPD, all right? We could go to the markets and sell, $17 or $18 put option, right? And try to own the stock at $18 like we did yesterday, right? Okay. Now, or you could today turn around, right? Pay $19.60, right? Pay $19.60 to buy the stock upright. Okay, that means right now in the market you could probably pay $19.65, all right? Okay, and buy the stock outright. Okay, and then you could look at, okay, you could probably turn around and look at selling the 3 months. Okay, we could turn around and look at selling the 3 months. All right, maybe let's say $20 call option. All right, $20 call option for the middle price, which is 155. Okay, 155. Right now, so what would you get? Okay, let's look at what would you get over here. All right, 1.55 divided by cost of the share, which is 19.65. That's 7.88%, right, in cash flow or income, right? 7.88% in cash flow or income over a period of 3 months. Okay, all right, now 3 months. That means if the stock doesn't move, right, from today, it just stays where it is, right, you're going to end up pocketing premiums that are equivalent to almost an 8% return in 3 months. So 8, 16, 24, 32, that's way over 30% for an entire year as well. Right now, so many of you actually think that trying to generate 20-30% on the stock is actually not doable. It's not possible, but it doesn't have to be difficult. Right, all it takes is a simple formula of some right stocks, which you must know, right, and you must know how to find them, right, and the right skill sets or the right strategy to apply on these stocks. Okay, now and options really make it simplified. Okay, it really makes it simplified over here. And on top of that, if you look at the last ex-dividend date, right, right, it simply tells me one thing, right? Along the way, all right, all the way to September expiry, all right, of this option, right, I'll be entitled to at least one or more dividend payments from the company, right? At least one or more dividend payments from the company. So that means if the dividend right now is 44 cents, okay, that means during this period, I will actually be able to pocket an additional income from the stock of another 44 cents, right? Because I actually own the stock, right? So this dividend is my entitlement over here. Right, so that adds on to the total return which I look at making over here. Now, what's my downside? My downside is only if the stock continues to shoot up. All right, it continues to shoot up. All right, I've actually set a maximum profit on my stock at $20. Right, so if it goes up to 22, I will have lost $2 in potential profits. All right, from the stock. Okay, by selling this call option. Okay, all right now. So anyone with a stock, right? This is the time to leave your stock in the comment section, all right? Anyone? Okay, last chance, okay? All right, now, so while we're waiting for you to leave your stocks and, for me to analyze different scenarios on them, all right, I'd just like to go over to our stock screener. Okay, now, so this is a board that, our members actually have access to, especially our new students, right? So let's say if today I want to go out there and I go and scan in our stock list, right? So IMP investors have our own stock list, and they're given this list by me. Okay, all right. So if they click on the AA list, okay, the board will make a suggestion to them, right, on stocks that actually passes our criteria. Okay, now, so let's say if today I'm going to go out there and I'm going to look at company, all right? So let me pick a company over here. All right, I don't see one I like. All right, so let's go to a different category, Class A. All right. All right, I see a couple of banks over here. All right, now since we're going to do a covered call, let's see. Let's stick with some of the better ones. All right. Okay. Let's pick out some. All right, now, so let's go back to our AA list, all right, and let's pick out UNM, all right, okay, UNM. Now, so if I click on the stock, right, the robot is going to go out and hunt out the stock details for me, right? So it tells me that this is an insurance or life insurance company, all right, listed in the New York Stock Exchange. Okay, right now, based on our analysis, all right, it is safe on a 5-year analysis level, right? It's also a moderate risk on a 1-year analysis level, which It's how we differentiate it in our community. Okay, and the next earnings date is sometime in July. Okay, which is quite a distance away, right? And if you buy the stock right now, you're actually looking at a 6% dividend yield on the stock. So the stock pays dividends. That's actually a good thing. It's a bonus, right? Because if I buy a stock, right, dividends are basically extra profits that I get to make from the stock. Okay, Belinda, we'll get to XOM in a while. Okay, we'll get to XOM in a while. Okay, now, so UNUM over here, all right? So I'm just going to go to the platform. Okay, Javon, we'll look at NWL. That's fine, right? So, all right, SKX, so Muru, all right? So we've got our 3 stocks for today. We'll look at SKX, which is, if I'm not wrong, Sketches, all right? And then XOM, which is ExxonMobil, and NWL, which is Noel Brands. Okay, Noel Brands. Okay, so we look at these 3 companies, all right? So first, let's go to trading platform. Okay, all right, so going back to my trading platform over here, let me change the setup a little bit, okay, to try and make the font size a little bit bigger. Okay. So this is UNM. UNM is down a little bit today, all right, 1749 right now. Okay, or let's round it up to 1750. So if you buy the stock today, you have to pay $17.50 for it. Okay, and you only have these choices to sell. Okay, you can sell a 30 days expiry option, you could sell a 3 months expiry option, or you could go all the way to December, which is half a year. Right now, so let's look at the 3 months first. So let's say we're looking at selling something that's right on the dot right now. Okay, so markets have corrected. We don't know if it's really cracked. So maybe I just want to focus on income. All right, now, so I'm able to pocket maybe around 135, all right, 135 by selling this 1750 call option. So what does it limit me, right? It limits me basically to no capital gains or no profits from the stock, right? Because the stock is sitting almost at the price right now, which is 1750, right? So all I'm going to make if this option expires is the $1.35 that I'm collecting upfront right now. Okay, now, so let's take a look quickly. Now, for this 1 month, all right, 1 month, right, if I'm making 135 divided by a cost of 1750, right, now that means I'm actually able to make 7.7%, right? If you go pick out your calculators and do a quick calculation, right, that's 7.7%, right, for 1 month, right? If you buy the stock and you actually sell the call option, that's pretty hefty returns over here. All right, that's pretty good. All right, pretty good if you believe, you know, this company in the long run, all right, which runs a life insurance business. Okay, all right, now, if you don't want to, just like Maureen asked me earlier, how do we pick the expiry? Okay, so first I'll look at 30 days, right? Then I'll look at 90 days. So 90 days tells me, all right, I can pocket maybe about 215, right? 215, so 215 divided by 1750. All right, that works out to about 12.3%, Maureen. Okay, 12.3%. So my decision is this: do I weigh 7.7% in a month heavier, or do I, rather collect 12.2%? All right, and sit back for 3 months over here. Right, so that's really the consideration. Yeah. Okay. All right. Now, so it seems right now, that it makes a lot more sense to just sell the nearest one, which is 1 month call option on the stock. Okay, it really does seem that, if you're willing to own the stock for a long term over here, it would make more sense to sell the call option that expires in a month time, right? And try to get $1.35 for it. Okay, all right. Now, it also, if you realize, gives you protection, right? Gives you a margin of safety for around $1.35 if you actually buy the stock today. All right, okay, if you actually buy the stock today. So what you collect upfront is also going to act as your downside protection if you own the stock and the stock price actually goes down. Okay, but remember, okay, if you choose not to sell the stock even after a month, if there are any losses, those losses that you're looking at are purely paper losses. Yeah, okay, all right. Realized losses only happen, right, when you decide to sell the stock. Yeah, okay. Now, so before you start such a strategy, right, make sure that you're starting off and doing it on the stock that you're actually willing to own. All right, now this brings me to a very important point. Right now, those of you who are listening right now, okay, do you want to know, right? Do you want to know what's the one thing that you should never do, Okay, the one thing that you should never do when you're thinking about selling call option. Right? If you want to know that, right, type I do. Okay, type I do in the chat box, right, or the comment box. Okay, type I do over here in the comment box. Okay, this is a very important point over here. That means you may like the idea, you may like selling covered calls. Okay, that means you like the idea of doing covered calls over here, but there's one very important thing which you should never ever do or think about doing when you're thinking of this particular strategy. Okay, type I do. Okay, all right, now. Okay, same thing over here. We have about 70, 80 of you joining us right now. Okay, now, all right, let me see 20. I'll keep the numbers to the same. All right, 20. All right, if 20 of you tell me that you want to know, all right, okay, I'm going to be sharing it with you. Okay, all right, so keep going. Let me count it right now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. All right, keep going, guys. All right, gotta help each other out. 12. We have 12 here. All right, who wants to know? Okay, all right, do we have more? Okay, there's many more joining us. All right, we have 13. All right, part of the reason why we do this over here is to just make sure that you are actually paying attention and you're actually going to be able to benefit, all right, when you actually do so. Okay, when you're looking at different strategies and knowing the key points. Okay, all right, we're up to 16 right now. All right, just a couple more. All right, keep going. All right, keep going. All right, great. Okay, now, so we're hitting the number. So let me tell you, all right, so the one thing that you should not do over here when you're thinking about such a strategy, okay, is to never ever do it on a stock. Okay, listen very carefully, is to never ever do such a strategy on a stock, all right, that you do not like to own. Okay, never ever do that. Okay, never ever do that. Okay, all right, because there are much better strategies. Okay, if you're thinking about trading stocks over here, all right, covered call is definitely not a trading strategy. Okay, remember this, covered call is definitely not a trading strategy, right? It's the same concept as if you're investing in property, all right? Okay, nobody buys a property, right, that you want to flip, right, and commits to a rent, right, for the long term over here. Nobody does that. Okay, only people who have a long-term outlook would actually buy and acquire a property, right, that pays good rental income. Yeah, okay, all right, now, so it's the same concept over here. Okay, now, so if you're going to do a covered call strategy, remember, right, it's the same idea as rental income on stocks. Right, so what kind of stocks will fit this category then? Okay, stocks that you're willing to own for the long term. Okay, all right, please do not make this mistake. Okay, now, so for example, okay, let's pick a very simple example. Let's say Hertz, right? So Hertz car rental company has already declared bankrupt. So definitely it's not a company that you want to hold for the long term over here. So you're not going to just go out there, buy Hertz shares, and then sell a call option even for 1 month. All right, you should not do that. Right, just to create those profits. Okay, you should never ever do that. Okay, you should only do it on stocks that you're willing to own. Okay, all right, now I hope I drive that very, very clear over here. Okay, now, so let's go to examples over here. All right, so let me quickly load up SKX. Okay, I'm just going to quickly toggle my screen a little bit over here, all right, because I want to show you how quick over here my bot, okay, can actually help me do fundamental analysis on companies. All right, so when I type SKX over here, all right, my trading bot actually tells me that it sketches, of course, as a company. Right, it allows me to know what's the stock price as well. All right, it clearly tells me that there's no dividends. Okay, there's no dividends over here. All right, and the filter doesn't show up. Right, so the filter is unable to calculate, right now if the stock is trading at fair value or is trading at good value or not. Okay, now. So the only thing you can do left is to dig deep, right? Dig deep into financial ratios, right? Which means things like your price to sales ratio, price to book ratio, your earnings per share, projections, and stuff like that. Yeah, okay. All right, now next stock. I remember Newell Brands. So let's go to Newell Brands, NWL. All right, okay, so NWL is pretty similar, right? It's a cheap stock over here at $15, okay, but it's unable to do calculations on it, so that means we have to look at the platform later on, okay? All right, now last one, ExxonMobil. All right, so ExxonMobil turns up. Okay, all right now. So ExxonMobil turns up over here is $47 right now. Okay, on a 5-year analysis. Sorry. On a 5-year analysis, it's safe. Okay, it's right now trading at a safe price zone. Okay, and then on a 1-year price analysis, it's trading at a moderate zone. Okay, so that's why it comes up. All right, it also currently has a dividend payment, which gives us a yield of 7%. All right, but it clearly shows you that the dividends is not exactly really safe right now, which we all know because of what happens to oil stocks and oil industry and oil prices, of course. Okay, now, so knowing this on the fundamental standpoint, this is where I'll take it right now. Okay, and go into choosing the particular trades. Okay, so let's go back to the platform. Let's go to the first company, SKX. All right, which is now at 33.80. All right, so SKX at 33.80. So if I'm going to look at it, obviously the stock has rebounded. Okay, right now it still seems to favor the bullish up move. Okay, so two things. If you are bullish and that means you feel that it's going to break this high, okay, you might want to just collect some income, right, and sell a call option at this strike, which is 37, right, 37 on my screen, marked by the gray point on the right, okay, $37. Or if you are more conservative, you could pick this one over here, which says $35. Okay, so we would, if you really want to sell a call option, you will probably be aiming at 35 or 37 call. Okay, now, so what kind of returns can you make? Let's take a look. You have to pay about $33.80 to buy the stock today, right? So if you sell the 35 call, right, it would pay you somewhere maybe around $180, all right, $180 for the 35 call, right? And the 37 call would pay you maybe around $110 if you pick somewhere in the middle, okay, somewhere in the middle. Okay, so if I'm able to make 180 divided by cost of buying the share, which is $33.80, let's say. All right, now that's going to bring me about 5% return. All right, 5% return. Okay, 5% return over here on the long run. Okay, 5% return over here on the long run. Yeah, okay, for a month. Okay, a month. Okay, now, but you are going to forego, okay, you're going to forego any capital gains and any profits, okay, if it goes over 35. Okay, that means if it goes over 35, you don't stand to make any more money on the stock. Okay, but you're exchanging it for a $1.80 payment upfront. Okay, all right, Muru, I hope that clears up the doubt. Then I'll come back to your question after analyzing the deals that we have over here. Okay, now the next stock over here was ExxonMobil. Okay, so let's take a look at ExxonMobil. Okay, you have to pay about $47.65 to buy the stock right now. Okay, and for 1 month as well. Okay, all right, let's look at ExxonMobil. Okay, if you do think that oil prices will continue to recover, you might want to sell a call option, which puts it at 55, which means, okay, you're still able to pocket the capital gains all the way up to 55, okay, which is decent, okay, for 1 month especially. Okay, but if you believe that, you know, it's just going to start channeling around here right now, okay, then you may want to pick 50, okay, which is the recent high over here, 50. Okay, all right, now, so XOM for 1 month, right? 50 call is definitely going to pay you more premiums. So you can see it's pretty liquid. You could get somewhere around 165 or 167, right? Okay, so let's say we take 167. 167 divided by 47.53, okay, that's about 3.5% return. Okay, 3.5% return for XOM. Okay, I believe, let me have a quick look. Belinda, right? So it was Belinda that mentioned XOM, right? So you could sell a $50 call option. A $50 call option on ExxonMobil, okay, which pays you 3.5% in returns upfront from the call option premium. And if the stock does go over, 50, okay, you will make an additional 250 on the stock, all right? A capital profit of 250 on the stock, all right? So that would mean you will end up making a total of 167, 1.67 plus $2.50 profits from the stock. That's 417 divided by 47.50. Right? That will give you a maximum profit of 8.7% return if the stock does go above 50, right? So 8.7% return is your maximum, right, for the next 1 month, right? Or if I'm not wrong, it was 3.5%, right, if it just stays where it is right now. Okay, if it stays where it is right now. Okay, right? So that will be for XOM over here. If you're looking at 55, right, if I'm not wrong, 55, the last high. Yep, 55. Okay, now, so you're going to be able to make only 55 cents up front. So 55 divided by 47.50, 0.55 divided by 47.50. That's a 1.1% return for a month, right? Ain't too bad, right? Because if you do this for 12 months, it's still 12% additional, okay? But your capital gains on the stock is much bigger. If it does go back above 55, okay, you'll make a 750 profit on the stock plus the 55 cents that you collected. So that's a total profit of 805. Okay, 805 divided by 47.50. So that brings your potential maximum profit, all right, maximum ROI at 17%. Right? So you see the difference right now? The 50 strike will pay you a higher premium, which gives you a higher return if the stock doesn't move. Okay, all right. But if the stock does move up, all right, the 55 strike packs a higher maximum profit return. Okay, all right. Now, so this is the difference when you choose different call strikes to actually sell, right, to partner up owning the stock. Okay, all right. Now, so last stock we brought up today, NWL. Right, so NWL pays a dividend, right? So it's not too bad. NWL pays a dividend of 23 cents, right? So owning the stock, you'll still be able to pocket a 6% dividend return in a year, right? So it ain't too bad after all. 30 days option, right? So let's take a look. NWL. Right, so it fell to $10 in March bottom, and it has since rebounded to a high of $17 before coming back down today to around $15. So if you're aggressive, that means you think the market is going to continue to surge higher. You would pick perhaps a 17.50 call or maybe 18. Right, so 17.50 to $18 call. If you don't expect markets to move, then you'll probably be picking $16 call option. All right, welcome, Belinda, welcome. All right, so $16 call option. Okay, now, so let's take a quick look. So for the next 13 days, you will pick either the $16 or the $18. Okay, now, so if you pick the $16, you should be able to pocket at least 70 cents. All right, 70 cents divided by 1560. That's a 4.48% return upfront. Okay, 4.4% return, even if the stock goes nowhere. Okay, even if the stock goes nowhere. If the stock goes above 16, you have a little bit of profit on the stock, which works out to about another 40 cents, right? Another 40 cents, all right? So 0.4 plus 0.7, that would be a total profit of $1.10 divided by 1560, right? That would be 7%, right? 7% in a month, all right? So 5%, I think it was 5% upfront, and 7% as your maximum profit. Okay, if you choose 16 strike. If you choose the 18 strike, you'll probably be able to only pocket about 20 cents maximum. So 20 cents maximum divided by 1560, there'll be 1.28% upfront, 1.28% upfront, or if it goes up above 18, that means you'll make 18 minus 1560, 240 on the share plus another 20 cents from the premiums. That's 260 in profits divided by 1560. So that's 16.6% upfront. So do you want to create? Do you want to pocket 1% upfront in cash flow, right? Returns, and then stand to make 16.6% if it goes up, or would you rather collect 70 cents divided by 1560? Would you rather collect 4.48% return upfront, okay, for a less capital upside potential? Okay, so this will be the difference that you're looking at over here. Okay, and all these three different stocks seems to be paying decent income, right? Even if you decide to own the stock over here, right? So we saw if you're willing to sell something that is very at the money right now, which is a strike price for the call option that is near the stock price currently, okay, they all pay around 4% levels, right? So they're pretty good, right? Pretty good. okay, because that's a month's return. So can you imagine, even if you just repeatedly do this for 10 months, right, you're hitting over 30%, right, on an annualized basis over here, just on a few stocks that we discussed. What's the prerequisite? The prerequisite is you must be fully comfortable owning these stocks for the long run, which also means, right, you must be able to bear the brunt of any possibilities of bad things that may actually happen to the company. Yeah, okay. Or I always tell my students this, right? For lack of a better word, right, you must be willing to die with these stocks, right? If you're willing to die with these stocks, then this strategy is definitely going to create some good returns for you. Okay. Now I'll take Zen's question over here, all right? And I think I have one more time for one more question, right? Because I have a live trading event which starts at 10:30 p.m. later on, all right, with a specific group of cash flow investors. All right, so I'll answer two questions. Okay, all right. So first one is Zen over here. All right, so Zen says it sounds a bit contradictory, right? Because if it's a stock that you would like to hold, okay, I would hope that prices go up. Okay, but after selling a call option and the prices go up, I lose the stock. Right, I need to sell the stock when the buyer exercises the option. Yes, all right, yes, right. So in this case, that's why when you are executing such a strategy, you have to pick the strike prices according to your outlook on the stock for this particular month. All right, outlook on the stock for this particular month. So for example, if we are looking at NWL right now, okay, it may seem on a logical standpoint, right, that choosing a slightly higher strike, right, which gives you a slightly better capital gains potential will make much more sense. Okay, will make much more sense. Okay, but if you're looking at a company like Wells Fargo, right, then you could see that, hey, it seems now that Wells Fargo is actually kind of sideways over here. Oops. Right, it's sideways where it's just channeling around this area, right? It's not going up too much, it's not coming down too much, right? And this top area over here is about 31, right? And the stock is now sitting around 28, right? So if that's the case over here, right, I may want to own the stock, right? But I may want to sell like a $31 call, right, on this particular stock to drive some income, right? Rather than just to sit and wait and do nothing, because if the stock goes to 31 and comes down again, I will get to keep the premiums. All right, and those are just additional profits. Okay, Zen, can you see why people will execute such a strategy then? All right, basically it's because they expect it to go up, but not to the extent of crossing over the call option strike that they're selling over here. Okay, so what they're really doing is trying to squeeze out that little bit of extra income, right, by selling the call options. Yeah, okay, Zen, I hope that answers your question. All right, I have time for one last question. Anybody? Right, anyone with one last question? I'll hold up for another minute. Okay, while I take this opportunity right now, likewise, if you join us late and you have not done so and you want to lay your hands on the summary sheet for the cover call strategy, which we have discussed in today's session, do make sure you click on the share button for the video and share it out. Okay, and I'll be posting the downloadable link in your shared post over here. Okay, after the session is done later on tonight. Okay, great, Zen, no problem. Okay, now, so seems nobody have further questions over here on covered calls. Okay, so that's good. Now, so if that's the case over here, I'm gonna move on. Let me go back to my PowerPoint and ready up contents for tomorrow. Okay, so back to the PowerPoint. So that will bring us to a close of day 17, all right, okay, and tomorrow, another interesting strategy for portfolio builders, right, who wants to make use of the benefits of options. Okay, now, so if you have a stock right now and you enter into a period, all right, you enter into a period where you're really, really afraid of making any losses on the stock, that means you're not even looking at any more upside on the stock, all right? But it may be a stock that you have owned for a really long time, say 5 years, 10 years, or 15 years, and you don't want to lose the stock, okay? You don't want to lose the stock. How can you structure a trade that will promise you that you will not create any losses? That means even if the stock falls by 50% from where it is today, okay? And if it happens tomorrow, if you structure this trade over here, you could actually achieve a no-loss result. Okay, that means, yes, you heard me correctly. There is actually a way to make use of options and structure, right, a no loss scenario. Okay, that means you own a stock, but you never lose money on the stock. Yes, that scenario. Okay, right now. So if you want to find out how to execute such a strategy, it's called the collar trade. Okay, stay tuned with us tomorrow, same time, all right, 9 p.m. live on Facebook as well as YouTube. So join us again at 9 p.m. tomorrow. And thank you very much for your time this evening. I hope all of you have learned something new, right, and something useful today as well. Okay, if you have not joined us on our Telegram group, do scan the QR code in the slide over here, or you'll see it on the bottom of the screen later on before we end the session, right? And click on join, and you'll be part of our Telegram group. Okay, now, so same time, same channel at 9 p.m. tomorrow. I'll see all of you again. Bye-bye. Thank you for your time this evening. Thank you. Bye-bye. All right, bye, Jacqueline. Bye, Josephine. Bye, Maureen. All right, bye, Javon. All right, bye, Anthony. Okay, welcome, Lydia. All right, bye-bye. Welcome, Zen. All right, I'll see you soon, Zen. All right, good night. Bye-bye.